Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Now, diversification should be an important part of everyone's strategy when it comes to investing, but it can be easily shifted one way or the other to over or under diversify. We're here to talk us through how to avoid these common pitfalls as Chartered Financial Analyst and the head of our investment committee, Jerry Herman.
That's right, Jim. Many people think they're diversified, but when you dig deeper into any given portfolio, we often find that may not be the case.
You want to choose a variety of assets like stocks, bonds, and cash and others. But you also want to choose ones whose returns haven't all historically moved in the same direction. So ideally, you want some assets whose returns typically move in opposite directions to help your portfolio hold up better during down markets.
Right, Jim. That way, even if a portion of your portfolio is declining, the rest of your portfolio is hopefully growing, potentially offsetting the impact of the poor performance on your overall portfolio.
Another important aspect of building a well-diversified portfolio is that you try to stay diversified within each type of investment. So, for example, in terms of your individual stock holdings, beware of concentration in any one stock. We usually advise our clients that a single security shouldn't account for more than 5 to 10% of your stock portfolio, and company stock no more than 25%. It's also smart to diversify across stock holdings by market capitalization, sector, and geography.
And another important consideration is stock overlap between funds. Many people select what they think are very different funds when in fact they may not be. Here's an example. These three funds are fairly diversified on their own, but if you dig a bit deeper into all three, you'll find that the first 5 or 6 of the top 10 holdings are actually the same.
You might think that you have 30 different securities, but in reality, you only have 18, which is almost half. So this means that when one of those sectors drops, it will have a negative effect on 2 or maybe all 3 of the funds. So this kind of diversification doesn't really help your portfolio.
And another key issue to maintain diversification is rebalancing. Rebalancing is the mechanism to replenish diversification. So it's not a one-time task. Without rebalancing, a portfolio tends to become more concentrated in the assets that have performed well, and the benefits of the original plan start to erode. For example, in recent years, given the relative strength in equities over bonds, U.S. equities over international stocks, and growth stocks over value stocks, it's entirely possible that the portfolio will become less diversified and may need to be adjusted.
And so when you rebalance, it's important to take advantage of tactical tilts as well based on market and economic conditions. So this is where your financial professionals should play an important role. For example, we have rebalanced and reallocated portfolios 3 times this year to help protect our clients from inflation. So this will also help them take advantage of other trends and forces in the market right now, like the shift from growth to value we have been seeing since the beginning of the year.
So as you can see, diversification may not be as simple as it sounds, particularly as your portfolio grows.
So if you need help getting your portfolio back on track, or if you simply want a second opinion, give us a call. Here's Chris Wall.